Welcome to the first episode of the Stock Market Stories podcast. The idea of this podcast is to interview traders and investors about the stories of their careers. My first guest is Peter Tu, who's an ex-proprietary day trader who now trades independently. I originally discovered Peter through the Chat with Traders podcast and through his amazing blog, which can be found at ptotrading.blogspot.com. In this episode, we talk about a recent study which asserts that consistent day trading profits are impossible. We talk about the most practical skills that traders should develop, and we also talk about some of Peter's opinions on things, like high-frequency trading and the idea of price improvement, and among other things, his experience trading at the world's worst prop firm during Hurricane Sandy. Here is my interview with Peter Tu. Maybe just a brief background of how you see yourself, because the blog has been like less active in the last few years. Maybe just like an update on like where you are trading wise in the last couple of years.
Okay. Well, I've hit like the 10-year mark now. I started making trades. I'm not even going to call myself a trader back in 2009, but I started making trades in 2009, like shorting AIG, stuff like that. And now it's the 10-year mark. Every year has been solid. I still mostly have the same core strategies. Nothing has really changed. Like I play earnings moves. I play new stocks. I play the low float game as much as I kind of hate it. I still do. And I also trade Bitcoin and a few other major crypto names. And that's pretty much where I am. That's like the state of my business in 2019. I just have my plays. I go out and execute. And I make a certain amount. And one thing I'm certainly struggling with is like drive and ambition. You know, it's kind of gotten a little boring for me, and I'm not really sure where to go next. And, you know, there's always, you know, pushing more size and more risk is something that I've kind of hit a wall on that, I guess. So, but I'm content with where I am.
Cool.
And I don't know. What do you want to? Anything in specific you want to know? I probably kept it too general there.
Yeah. I guess just describe, succinctly, so your how you got into trading, and then I guess your just core strategy.
It first started with poker. I built a bankroll in poker as a teenager during the poker boom, and then I transitioned into trading when I was in college. And then I took the further step of going out into prop trading in New York. That was around 2011. I think the financial crisis really motivated me to keep up with the headlines and understand markets. It just kind of captivated me. And the core strategies I've developed are really just simple momentum, trend following strategies on stocks with fresh news or recent news or interesting stories and volatile movement. And I'll trade things like Bitcoin and crypto whenever there's a fresh cycle, I guess, when it's bullish. It tends to be something where I can spend an entire year not trading it, and then spend an entire year waking up at 3 a.m. to trade it whenever it's like making new highs and all that. So,
And you use generally the same like momentum-based price action strategies to trade cryptocurrencies as well?
Yeah, generally. It's a little different because there's the 24-hour market. But in general, it's just understanding like timing, price movements.
Do you find that they move differently than the stocks you would usually trade?
It's similar, but on a wider time frame, which can make it kind of uncomfortable to manage. So I don't think they move that differently. No.
Cool.
Like Bitcoin moves very similar to like a low float stock or a momentum name like Roku or Tesla, I think.
Interesting. So I guess I'd like to start out by asking you, in July there was a paper that came out from a Brazilian university, and
I read it.
Yeah. So basically they asserted that consistent day trading profits are close to impossible, and those that do achieve consistent profits hardly make a wage better than that of a bank teller, and when they do, they're taking on massive risk compared to the returns. So obviously you're a consistently profitable day trader. Do you have any thoughts on their methodology and the conclusions they came to?
Well, I'm glad this paper exists. Now anybody who asks me if they should trade for a living, I'm just going to cite the paper. I'm going to text them the link. I'm going to be like, yeah, don't do it.
Right.
I guess from the vantage point of being a trader, I guess everybody wants to know is like, how are you not just one of the like super lucky ones? Like, they always come up with these analogies like, if a bunch of people flip a coin, like if 1 million people flip a coin in a coin flipping tournament, then there's going to be like one winner, right?
Mm-hmm.
Have you ever heard that analogy?
Yeah, one guy is going to keep hitting heads,
Yeah, and that's kind of how they explain people, the money managers who beat the market until they suddenly don't. Like, I believe there was a guy like Bill Miller. He beat the market like for many, many years, and then he finally got killed in like the financial crisis, which basically brought his like average return back to like market rate returns or something like that. Well, first there's the Warren Buffett argument. It says that if there's a disproportionate amount of like successful coin flippers from the village, then, like that concentration of winners cannot be explained by chance. And he called like that village like Graham and Doddsville because a disproportionate amount of the successful money managers were adhering to like a certain value strategy, right?
Right.
So, it's kind of this proof of an edge where like if that certain subset continue to be winners, then it's almost like you can kind of flip the math back against the naysayers and say that it would have to be like a 6 sigma coincidence for all those particular traders and money managers to keep winning rather than it just being a random distribution of all participants.
Right.
So that's one argument. And then I would also bring up like, I think the paper shows the odds of jumping into trading without an edge for the first 1 or 2 years. Like if you have no edge and a small bankroll and you just try to figure out on your own, yeah, it's probably going to be like a 97% chance of failure. You pretty much have to find an edge by accident. Of course, that's assuming none of these study participants were like Googling stock trading strategies or Brazilian futures trading strategies. I don't even know what's even out there on that kind of that market, but I'm guessing they didn't have a lot to work with. Like they didn't have like professional help or mentoring, or they didn't have somebody over their shoulder with a known edge saying, okay, you got to do this. You have to buy on this certain signal, and exit on this certain signal to make money. Because I've been doing this 10 years. Just do it. I'm guessing they were just drawing lines like, oh, it's a triangle. Triangle converges. I'm going to like get in or something. I'm going to guess that's what they were doing. And if so, 97% sounds about right. And I think I think for a new trader, it's a good information to digest. Not to say that day trading is impossible, but to say that success has a lot of obstacles to overcome. And, it doesn't, it doesn't take into account what happens if you start with an edge. Like, take the famous example of like the turtle trend followers with Richard Dennis and William Eckert in the 1980s. Like those guys started out with an edge, and a lot of them, I believe, went on to become successful fund managers. A few of them, and then much of them had success for at least a good like few years before maybe struggling later.
Right. Yeah. I mean, a lot of them are still CTAs. So.
Right.
What was really interesting about the paper is that they specifically selected new traders. So they, like you said, they didn't presumably have an edge yet or any sort of experience. But what was interesting is they found that as these new traders traded more with their lack of experience, their average loss per trade increased. So you hear a lot of people like Linda Raschke, really, really successful trader.
Mm-hmm.
She recommends that new traders, they have to learn through experience. She doesn't really recommend books or any of this type of thing. She says just start trading. Do you think that maybe that's a flawed view, or do you just have any thoughts on that?
My first thought is that it is true in a way because it is necessary, but is not sufficient, if that makes sense. Like, you absolutely have to trade to get better at trading. Like, you can't like theory ball your way to good trading by doing like mental equations in your head. You actually have to do it. But at the same time, it's not sufficient. Like, if you don't have any edge and you just keep trading, like, why do you think you're suddenly going to have positive expectation? Like, your experience has to be meaningful. Like, it has to come up. It has to discard the ways that don't work and accumulate the ways that do. And for some people, that never happens. So it's necessary, but not complete. That's my take.
Gotcha. Now, I guess just to close on this subject, with the findings of this paper in mind, how would you suggest someone that's on the cusp of profitability, sort of they're actually seeking out education and podcasts like these and trying to improve, but they're not seeing the success. What do you think would be like one sort of skill or something that they should really, like 80-20, what should they spend most of their time doing?
They really have to, I mean, it all comes down to that edge, and the more defined it is, the better. I think a lot of people who are on that cusp, they don't realize how vague their edge is. Like, they only have like a very, like an outlined, faint idea of it, and there may be other red herrings that they kind of in the way of them realizing that. Like, they think it's their emotions or their execution, but really they just haven't defined it well enough. Like, they don't know exactly where their entry has to be. They don't know exactly where their exit has to be. And they're not taking the guesswork out of it. And I think the way to fix that is to just keep backtesting and reviewing results and being like, and having defined solutions that you apply to these results, the data being like, my entry, let's just take an example. Like, my entry signal is when these moving averages cross or whatever. That probably doesn't work in real life, but let's just use that as an example. And you're going to have to say, does that work on all the plays that meet my conditions? Like, the last 100 trades, does that moving average cross work as a signal with a defined stop and a defined condition for victory? Say, at the end of the day, does it make money? With a trailing stop, does it make money? With a target, does it make money? And you have to keep making it that precise, which can be a really grindy, boring process, but you have to do it. And The frustrating part is that some people are successful without doing it, and they just keep working off that faint outline. But because I don't know, they just have like a natural inclination to trade. But you just have to like get that out of your head and be like, I can't be like that. I have to keep defining it and making it work to make money. Like I'm not going to be like the LeBron James of trading. So I want to say that everybody has to, I mean, it's going to sound like it's not a fair world because it isn't. I mean, it's like not everybody has to do the same amount of work to get to where they need to be. But if that's where you have to do, then you have to do it, you know, just if that makes sense.
Right. Yeah, that's excellent advice. So you would definitely recommend new traders maybe not take the advice of these outlier baller traders that are able to just get some pattern recognition skills.
You're going to find some real traders who have a good touch, and it's, you know, many of them are fake, of course. Yes. But I can verify that some of them are really good, and they haven't put in that much work to like define everything, and they're just good. And and if they wanted to, they could brag on Twitter. I just made like 50K in a day, and like I just felt like that was the spot to get in, and that's like their explanation for why they got in. And it's something that could really mess with you when you're starting, because you get discouraged wondering like, why can't you just see what these pros see? And you miss that there is a path to incrementally get there by defining exactly what you need to do. And that's what I would just focus on if I were on the cusp. You know, like if I had an idea that if I had a good idea that stocks were breaking out on these certain conditions, and I trusted that these observations were sound, but I just so close, then really it's just about pushing the ball from the goal line into the end zone. That's what I think it is.
Right. So
one more thing I have to add is that you also have to identify that that's where you are. You can't be delusional that you're actually on the other side of the field and you're not that close, obviously.
Right. So I guess for those listening, to form that habit of, you know, modeling market behavior, to really reduce the friction, do you have like an action plan, like a certain platform that you think would be palatable to a non-programmer, and maybe a tutorial or something that you found, or just a way to really get them going quick so they don't spend so much time trying to find the right platform and these sorts of things that don't add to their bottom line?
Sure. So to start off, I trade stocks, I trade equities. That's my market. And there are a lot of sites that let you test different things. So you're going to need an equities kind of a back testing software. Like the one that I use is called Profit SPI. I'm going to bring it up right now just to kind of warm me up on the mechanics. But what I used it for was to look for certain criteria that would make me want to trade a stock. Like, why do I even want to trade a certain stock? First, you have to say, why do I even want to trade a certain stock in the first place?
Right.
So let's say you want to be one of those like guys who like trades low float stocks. So the first thing you do is you bring up your scans, maybe, or your like the top gainer on the day. Oh, this is up 100%. Maybe it's going to be very volatile. Maybe I can make some money on it. So on Profit SPI, I look back a year and I say, I want to find all the stocks that gapped up 50, 100, 200%. I want to make sure they're over like $5 or something. Maybe you want to say they're over $2, $3. It all depends on your preferences, and they're over a certain amount of volume, because, you know, I don't know if you want to trade things that are like 100K in volume. So you have all that criteria. You have the gap criteria. You have the price criteria. You have the volume criteria. So you enter that into the Profit SPI, and then you get a spreadsheet that says this is every stock that meets that criteria in the last year. You know, let's say it's a sample of 300. And then what I'm doing is I'm looking for I'm trying to test out exact entries and exits. So one entry and exit signal was like kind of like an opening range break. Like there's a block interval of 30 minutes on the open, which most people say is a more meaningful time period because there's more volume and volatility than say at 12 o'clock or 2 o'clock in the day. And those price level high and lows may define the trend for the day. So I'm looking for like, I want sustained momentum. So I want entries where like it's a new low or a new high and I get in the direction, that same direction for more new lows or more new highs. And I want to eliminate situations of whipsaw, which is that it makes a new low and then there's a new high like 5 minutes after that and I get stopped out. So I'm just manually back testing that on the, what I used was the Thinkorswim on demand platform where you can dial back into the time machine and, you know, you find the symbol. Let's say it's like ABC on December 23rd. You go on the on demand and then for December 23rd, you enter ABC and then you say, okay, if it breaks that 30-minute low, what does it do? Does it close at the lows for the day or did it actually or did it stop you out? And then you look and you have to go through like 100, 300 of those and you'll be like, okay, so I did all the math. And it seems like whenever the signal occurred with the new low or the new high, 7 out of 10 times it stayed in that direction into the close, and that's good. So that's a good start. Like you have like an edge. If it's like 50%, 40%, then you're like, okay, then it's kind of random. Like it doesn't seem like momentum is sustaining, so I have to find a new entry method. So that's kind of what I've been doing.
Cool.
That's what I've been picking up the last like 1 to 2 years, trying to, refine some entry exit strategies, but still having the general idea of like, stocks in play might trend a lot.
Right. Yeah, that's great stuff. I think someone can take that.
I hope that was specific enough.
Yeah, I think it definitely was. Yeah. So moving on, you traded for a prop firm from 2011 to 2014, right?
Yeah, that's right.
And a lot of the stuff on your blog is stories about your experience. You had that was it American Airlines? You had the Fannie Mae trade.
Yeah.
So it seems like today, prop firms, the prop industry is declining. Less and less traders are going into an office with other traders. Everyone's, Twitter has sort of become like a digital, prop desk, maybe.
Yeah.
So maybe if you can say, do you see that as a positive thing, or do you think more traders should be seeking out situations like that, like a prop firm or something similar?
I think it can be helpful if you're at the right firm with the right people. I think that's the key. Like what kind of people you're surrounding yourself with when you're at the beginning of your career, because you want to be a machine that's just kind of like eating up, vacuuming all those little edges that other people have picked up. Like the guy's been around for 5 years and been making money all those 5 years. You have to be like interested in what he's going to do. So I do think a prop firm can be a good experience. Some of them are pretty transparent. They have like ways of showing you how much everybody has made, and the people who are making money and their positions, and that's a pretty helpful thing. The problem with like Twitter becoming this digital prop firm is that there's very little transparency. You have no idea like who's just making things up or what they're doing.
Right. As a side note, do you see, it seems like Twitter in specific has just become, the place where just traders and investors congregate. Do Do you see generally it as a positive or negative influence on the, majority of people?
Uh, um, I want to kind of not take a side. I feel like it's what you make of it. There's a lot of good and a lot of bad. For some reason, some people are a little on the more naive side of their life. They don't have as much wisdom, and they gravitate towards the not so good. And some people are able to filter out the people who know something, and they really make something out of it. There's a lot of good out there. There are legit traders out there with very good information. So I'm gonna say I'm not gonna take a side. I'm gonna say it's kind of it's a blank slate. It's kind of what you make of it. If you follow the right people, you'll be on the right track, and if you follow the wrong people, you'll be on the wrong track.
For sure. So, in one of your blog posts, you referenced that during Hurricane Sandy, maybe you had some outages and you had to trade with what you call like the worst prop firm ever. You want to just key us in on that experience?
I remember, yeah. It's the whole financial district was knocked out. It was just so poorly equipped to handle like that kind of flooding. And then our building, like even after the flooding, it had mold problems. And so we had to, managers had to cut the deal with, another firm in the Trump building on 40 Wall Street. And I walked in there, and it was a poorly lit room. The computers are really old. You saw people, there were a lot of people, and they were I didn't recognize, and they were all like shuffling around, and they would congregate to listen to this guy who I think ran the firm. Very Long Island type of guy, like bold, booming voice, slick back hair, just constantly talking, and like I don't know. He just had a certain rhetoric around him. Like he's been around like boiler rooms. And the one remark, well, he was trying to teach a bunch of people how to trade. The one remark that always stuck with me was when I overheard him saying to a young lady, you need to trade as many shares as possible on Netflix. And then if you weren't comfortable with it, you just have to have a tighter stop. That was such a huge red flag to me that he would say something like that. Because one core tenet of the burn and churn prop model, the bad prop model, the prop you don't want to join, is to make new traders trade as much size as possible to generate commissions, but also keep the dollar risk as low as possible so that their business can last longer. So you're just kind of like trading a bunch of size and getting a bunch of commissions and going nowhere for like as long as possible, and they make the money and you're just kind of wasting your time. And I thought that was a pretty big red flag that he would say something like that. My managers, to their credit, at the very beginning, they tell new traders, you trade very small, and the only way you can size up is if you've proven profitability and you have the confidence behind it. I mean, that just makes sense. Like, why would you trade big when you know the least?
Right.
I heard that, and I was like, yeah, this guy's that kind of guy. I don't know. I hope we don't stay here too long.
Right.
Unfortunately, nothing more interesting than that, because we only stayed around 3 days. But interesting character, interesting place to be for a few days.
Yeah. Maybe after the boiler rooms from like Nassau County fell apart, he just joined the prop industry. This guy, it's interesting.
Yeah. I think I looked up today. His firm was acquired by T3.
Oh, wow!
They acquire everybody. I don't know, like what that business model is all about, but like I don't know. They acquired like WTS. They acquired like I don't know. They're just becoming like the biggest prop firm of no name prop firms, I guess. So.
Right. Seems like they, outside of the the Jane Street type of prop firms, it seems like when you look for proprietary traders on LinkedIn and stuff, 80 to 90% of them, it says proprietary trader at T3 Trading Group. So they play
a volume game. That's what they do, and I guess I won't go any further than that. Not going to criticize it. It's just it is what it is.
Right. So you've also referenced how the 1990s was like a golden era to be a stock trader, but especially so a proprietary trader. And I'd really love to hear your thoughts on that.
Yeah, I mean, it all started with reading Dark Pools by Scott Patterson, which I highly recommend. It's like one of my favorite books on trading, on like the history of trading. And I wish there were more books like that, like a specific era of trading. Dark Pools went over the 1990s of like Daytech Securities, and really the first people to like trade on a living on their computer through an electric network, which was, I believe, Island Trading. Mm-hmm. Daytech had a guy named, like a brilliant wonderkind guy named Josh Levine. Was it Josh Levine? That's his name? I want to get his name.
Maybe Citron, I think his name was, or that was one of the other guys.
Yeah. Anyway, this Levine guy came up with the first ECN island, and then he came up with like a watcher, which could like scan stocks, and he came up with like a platform. And suddenly you had like a trading firm that could just click buttons and make money. And just the clicking buttons in and of itself could make money. Like, you talked about So's Bandits, right? Like, have you read the book, by the way?
I have not. I had to write an article about the So's Bandits, which really made me excited to ask you about this, though.
So do you understand like how like the So's Bandits made money, like the exploit?
Right. Yeah. Well, they had instant access to market maker quotes while market makers were physically trading.
Yeah. So what happens was that there was something called the small execution system, which was designed so that retail traders could get their small orders filled before the institutions could. And they would get first priority. And I think this happened because people were outraged about like the Black Monday and like, oh, the little guy can get out. So they created this SO system designed so that the little guy wouldn't have this disadvantage. But it became this exploit where like a pro trader, anything under like 1,000 or shares would get priority to a fill. So you would have these market makers that were slow to move their quotes, and using the SO system, these guys would find a stock that was about to move from like, let's say, Yahoo's moving from like 200 to 205. You would have a stale offer at 201, and they would just click a button to snipe that 201, knowing that it's going to be bid 205 in a second or two. So they would take that slow quote using the SOs, and they would have to get filled because of the rules of SOs, and then they would just flip it in a few seconds. So they just cleaned up the market by finding these order flow inefficiencies.
Right. So it was almost like early high frequency trading. Yeah,
manual button. I wouldn't call it high frequency because it's more because the humans are clicking buttons to do it. But I guess, I mean, that's how it all started from what I can tell. And that's how those guys made a bunch of money. I do talk to some people who were part of that era. They say it started like that. But it wasn't entirely that. That was kind of like, that became something where after a few years, it became something where it happened, but you were kind of lucky that it happened. And you couldn't like make a living out of it, And he told me that how people really made money, like the top traders at his firm, and he was at Daytech. He was in that firm, Heartland Securities, Daytech, with Levine, Citron, and Shelley Mashler. And he said that the guys they started out that way, but they became like real students of the market who would just understand how markets move, and they would trade these like high flying names that would go down like 20% in a day. They would just buy it. They double down as it went down more. They triple down if it went down more, and they would just like fly back up, like almost in straight lines, like once the bottom was in, and that's how they really made the big dough. So It wasn't entirely like that So's exploit. That's how it started, of course. And that's how they built the technology to kind of build upon that. But really, like the guys who made the most money were just taking advantage of the tech bubble volatility at that time.
So you see, so this golden era of 90s trading more as a market environment than a like a market structure thing?
It was both. It was definitely both.
For sure.
And like without being there, it's hard to like say, but it was interesting because I had the impression it was more of a technology thing. And then like I actually talked to a guy and he says like, although that was a lot of it, like, you know, the biggest guys were also just taking advantage of the tech bubble and taking big risks for massive ranges.
Right. So we talked about the SO system and how that might have been that was a catalyst to further order flow exploits by, you know, as technology grew. So now, of course, we have high frequency trading, payment for order flow, and you have you know, these firms like Virtu and stuff who are executing just massive amounts of volume each day, and you're trading with them rather than, you know, you know, if I were to sell and you were to buy from me, we're not dealing with each other, type of thing. And you know what's really sold to the public, and you hear even people like Matt Levine who get behind this argument, which it may or not may be right. The price improvement argument from high frequency trading, but you know, you're someone that's trading stocks on a very short time frame, so I think you would, you know, have a much better lens than someone that just buys ETFs passively. So, what are your thoughts on that argument? Have you seen the way markets move shift from this and that sort of thing?
So we're talking about HFTs and kind of their effect on like market here,
right? And maybe if you see it as positive, negative, or just don't have an opinion.
So I mean, I think there's a segment of people who think like HFT is ruining the market. It's got to be regulated or whatnot. I don't know if that train has slowed down in the past couple of years. I don't really hear about people talking about HFT as much, like how it's like it's kind of become the new boogeyman. And I feel like that's kind of the right word because like connotation is that it's really more, the idea of it is more scary than the reality. That's kind of what I think, at least. I'm not an expert on this stuff, but from secondhand reading, I feel it's not really as bad as people think. I mean, there are studies that show they actually reduce costs. I mean, back in like the 70s, you had to pay, I mean, some people were paying like $100 in a trade. I mean, it just seems crazy to me.
Right.
So, and take this for what it's worth, but when I was really obsessed with the topic and I read more accounts about it, like from people who weren't just full of rhetoric and they were actually there, they would say that people in the 80s and 90s, brokers, the pit traders, they would just constantly find ways to screw you anyway. Like, and HFT is just kind of the same game where it's the cost of doing business, but it's not even as bad as it was in the past. Like, yeah, they're cutting, but you know, that's kind of like the incentive. People are always going to want to cut, and there's always going to be like an adverse selection problem that I don't think you can solve. Like, you know, I say that, Dark Pools is one of my favorite books. I think the flip side is like the Michael Lewis book, Flash Boys, which is kind of anti-HFT. I think that's kind of like a overrated book. Like, there's a lot of like criticisms about how institutions, they try to put a big order on the market and the market makers back away. like, oh, I can't sell my 500,000 shares without slippage, right? Like, I mean, like, but when you think about that, of course there's going to be some slippage. Of course they want to bag away because people who trade size are more likely to be informed traders, whether it's because they're smart or because they know something they shouldn't. Either one is bad. So it's like, why do you want to take a bet against an informed trader and get dumped on by that person for the most possible shares at the worst possible price? Like, that's not a good business model. If I'm running a market making firm, I don't want that as my business model. So there's always going to be that problem. And, you know, it's existed since the beginning of markets. So empirical studies show that the costs aren't really that great with it, aren't really higher with HFT. They're lower, actually. So I think it's probably not as bad as people think. I don't know if I'm informed enough to say it's a good thing, but, you know, I suspect pretty soon people are going to jump off the HFT train. The HFT makes the market rig train, and they're going to start blaming all these free brokers selling their data and their trading routes to the institutions like Robinhood. Like, that's going to be the new boogeyman that explains why, you know, this happens or why the market is so unbeatable. So I think it's overblown, and I think as long as you're not really like micro scalping for money, and I really don't even know anybody who does that anymore to make a lot of money. Like, I don't really scalp that much. I'm holding for like hours now. So I don't think it really affects my own personal trading. So I think it's kind of a red herring as far as for an everyday trader to think about. I wouldn't worry about it.
Gotcha. Yeah, I think that's a really good view. So moving forward, a big theme of a lot of the content you've put out has been that most traders never either have the opportunity or never think about just going beyond, you know, regular vanilla technical analysis, just like momentum stocks and this sort of thing. And you've talked about some more sophisticated strategies that you saw people use at your prop firm and that maybe you applied a bit. Do you think there's a way traders can seek out these more idiosyncratic ways to make money, or is it just something you sort of fall into?
You know, going back to your question of whether like joining a prop firm could be good, I think that's one of the big advantages of joining a prop firm is that you can learn different strategies other than you know, technical momentum stuff like up is up and down is down. You would like the first real like aha moment for me was when I see people make money on imbalances. And for people who don't know what imbalances are, it's like the exchanges, the NYSE and the NASDAQ. They have like kind of a unique auction system where there's like an opening imbalance and a closing imbalance for almost every major traded stock at the beginning and the end of the day, where like they're gonna say there's a million shares to buy or sell, and then people are gonna have to match that order with market on open orders and market on close orders. And that's going to determine, and like whatever the supply, whatever orders they're getting in as feedback is going to determine how they're going to open the stock or close the stock. And it's kind of this esoteric process that even I don't entirely know how it works. You know, it's something I wish I could kind of be on the inside on to really like to like be behind the market maker who's running that thing. But anyway, so that's the imbalance, and there are people who make money off this by being the people who match those orders to the imbalance. Like they say there's a sell imbalance, stock's at 60, and they're going to enter in short orders because they think the imbalance is going to continue and it's going to print at 59. So then they get in at 60, they expect the stock to print like 59, 58. So they just push all their money in and they pray that it prints in their favor. And I can't really explain how they find this edge because every time I talk to one of those guys, they're like, it just kind of works out this way because of reasons. But what I've seen is that the profits are clustered on days where there's a rebalancing on an index or options expiration, either one. So on the days where, let's say, the MSCI or the Russell is making imbalances, you'll find certain stocks that almost never have imbalances, like mid-cap stocks that aren't traded very frequently. They're going to have very unusual imbalances. Let's say on average, they have 1,000 shares in balance a day, which is like nothing. Like that's just a normal Friday for them. And then on this certain rebalancing day, because they're getting included or removed from the Russell, now it's like 500,000 shares, and the stock trades a volume of like 50K on average. Well, that's pretty crazy. You have a block that's like 10 times the average volume. Like, of course, that has to be moving the stock quite a bit, right? So on these days, then there seems to be some kind of edge. Unfortunately, I haven't put 2 and 2 together, and I can't explain that edge, which is why I'm not doing this myself. But, you know, I would see guys trade like 50 stocks in the last 5 minutes, automatic orders to close out. And they would just take in, like, everything would print, and they're like, oh, I'm up $50,000. Boom. 5 minutes. No analysis.
Right.
They just see the imbalance. They take the side of the imbalance, meaning, you know, buy a balance, I buy it. Some people do the opposite, where like they fade the imbalance. But I have no idea like the reason behind why they do any of this. I'm just telling you that I found people who've been doing it for 10 years, and they consistently make it work, and they have the biggest days at the firm. And I am quite jealous, but I haven't quite figured it out.
Right. So, I guess, how do traders sort of seek these, if there is a way, seek these, maybe not like, you know about this imbalance and you've talked to traders about it. Maybe you don't trade it, but you've sort of found that thing that a lot of traders have never really heard of. So is it just networking with traders, or is there...
Yeah, I think you got to network with a trader who knows what he's doing. Like, I don't know how... When I Google, like, imbalances, I find, like, nothing out there on this subject.
Right.
It's just so closely guarded.
Right.
And I don't know. I did meet a guy who he was in one of those major imbalance firms. They were like a rival firm with ours, and he went independent after 8 years, and he still trades them on like a occasional basis. And I talked to him and be like, "Oh, why did you do this? Why did you do that?" So I try to figure it out that way. So, and even then, when I talk to people, I still like. I sat down with dinner with one guy who traded it, and that's all we talked about. And I still really only got like 50% around to like what was really going on. I don't even know if they really understand, but it's great when you struggle all day on a volatile stock to make like a few thousand, and they're like, "Oh, I just made like 50K in 5 minutes clicking buttons, and I did not sweat any of these moves at all because they just happened instantaneously."
Wow.
Makes you feel like, why am I doing this momentum trading stuff where I have to like look at the stock go up and down and like I'm sweating it out with size, and they're just like, "Oh, I know right away whether it works or not."
Right.
My job's done in 5 minutes, and the rest of the day I was playing Counter-Strike or something.
So
that's what they do. That's what some of them do. They just play games until the last 5 minutes.
Wow. How would you recommend a trader go out and form a network? Because I assume most people, it's mostly Twitter. Maybe they're in some chat rooms, but they're not sitting down to dinner with traders. Like, do you go on LinkedIn? How do you find these people?
Now that at this point, I want to say that maybe Twitter is kind of good, because like you kind of have to be bold and get in people's DMs and ask them about whatever you're interested in. Hopefully they're in the same area as you, obviously. If you live in New York or Chicago. A lot of people DM me, and like I'm always willing to like talk to them or whatever. I mean, I hope that's not a friggin' like advertisement for everybody to listen to me if you're listening to this. But in general, I try to help people out, and I think if you're persistent about it, you can find a network through LinkedIn, just LinkedIn, Twitter, and chat rooms and trader meetups or whatever. Really let your curiosity flow and try to, Don't get into the herd mindset of being like, oh yeah, we all do the same thing. It's great. Really find people who do different things and really pick their brain. I think it's possible. I mean, I don't know how you do it if you don't have a bunch of money and you're living in the middle of America, but maybe you can Skype. I don't know. Be creative. That's what I suggest to somebody who's just in it right now and they don't know exactly what they want to do, but they know they want to like immerse themselves in markets and trading. Find the people who are sharp, ask them who they think are sharp, and just keep talking. Just keep, buy them a beer, buy them a coffee or something.
Right.
Something to make it worth their time at least. Be gracious about it. That's what I would recommend.
It's really interesting that you're making this point right now, because I know personally I've listened to lots of podcasts and just seek out information, and I think simple things like this really never get touched on. The fact that all of this, why are people going to publish this information publicly? So when you go out to a bookstore or a course provider or podcasts, why would they talk in depth about these little inefficiencies that they take advantage of?
Right.
But usually the thing is like, oh, what's a good book that I can go home and read and become a better trader? But maybe it's, hey, go find some traders and learn from them. Go, network.
Exactly.
Like in business, what do you don't just read books, you talk to other business people, it seems.
That's right. And, trading is a business, and you have to look at other business models that are successful to create your own. There are very few people that really have that ability to just do it from scratch, just do it from pure observation from their own screen. I really think you have to find a shortcut. You have to find a shortcut by talking to people. I mean, why are we even trading if it's not a shortcut? If we're not attracted to the fact that it seemed like a shortcut at the beginning of our lives, we're like, oh, it's better than having a career and making stable money. It's a shortcut to wealth. You kind of have to access that part of your mind and be like, how do I find the shortcuts to success? I mean, obviously, there's going to be hard work, and you do have to trade to learn how to trade. But as far as finding that edge, that should be your shortcut. How do I find my edge right away? Why do I want to struggle for 3 years not knowing what I'm doing? Why don't I just find my edge on day one?
Right.
It can be done. People are always saying oh, you gotta lose the first account, you gotta blow up. And it's nah, I didn't. So that's my brag. I didn't blow up. Well, fuck it. Find your edge right away and don't blow up. Be the guy who builds that $1,000 account and never blows it up. Why not?
Right. Yeah, that's awesome. I love that. So I think this naturally flows into a question I really wanted to ask you. Is I've read on your blog the idea of in any good trade, there's the innovators and the imitators and then the idiots. And once the idiots get on the train, it's gonna end pretty soon, sort of. So, do you see any trades like that are becoming super crowded? Maybe the idiots are jumping on board around now.
Yeah, I remember that post. It was about AEPI, and it was a play I didn't really understand. Yet every day, more and more traders were getting in it, and they didn't understand why it worked. And then all of a sudden, there was a day where we all had to unwind, and that's why it went the opposite direction. And I still can't exactly explain what happened there, but it seems like a good example of something actually being crowded. Nowadays, you hear the word crowded, and everybody's throwing it around on Twitter, at least if you're in the penny stock niche, part of financial Twitter. And I don't know if they know exactly what crowded actually means, or whether they can prove it or not, or whether it's just theory ball. Or I'm going to take the point of view that it's not okay. As far as penny stocks becoming parabolic and running a billion%, and whether you can short it or not, or long it or not, I'm going to say it's not relevant whether it's crowded or not. because I don't know how you can come to the conclusion definitively anyway, but you'll see a lot of chirping on Twitter. It's crowded. And first of all, what does it mean? I think for the most part, it usually means that, well, a lot of people are short. There's a lot of shorts in the stock. Shorts tend to feel pain and cover aggressively more so than buyers, I guess. So what does it mean? Okay, so the bears are losing and the bulls are winning. So, I mean, shit, that's the same story as the last 100 years on any market that's ever existed, in my opinion. Right? Supply outweighs demand. So you're not really saying much when you say a stock is crowded because it's full of shorts. If that's what you're saying, forget it. Just trade it. Don't overcomplicate it and make it sound like you know something that others don't. And we've seen stocks that are full of shorts actually go down. Yeah, they do go down, you know, like Overstock or Tesla earlier this year from $300. I mean, bunch of people were shorting that. I mean, it's been happening since like the 1990s on Yahoo message boards where people would say, oh, the shorts are in it. That's why it's going to go up. That's not why it's going to go up. You know, it's one factor of many things. It's not an edge that you can look up the short vote percentage or that you know your neighbor, your trading neighbor, digital neighbor, so to speak, is shorting 10,000 shares of this piece of crap stock. It's not an edge. Understanding how to time it is the edge, and understanding timing and momentum. You honestly never actually ever need to acknowledge the stock's short percentage. You just know how to time whether it goes up or not. And I think it's really become overblown, and I think a lot of it comes down to needing an explanation or a narrative to trade. We can't accept that some sketchy Chinese company that has no financials is up 500% for no reason. We have to say that it's because somebody knows something. We have to say that it's because this big trader got caught short. We have to say that the market makers are up to something. And I do that myself, even subconsciously, you know, after all these years, because to understand why something moves will add conviction, even if you're like way off base and there's all conjecture. It really does add like a conviction more so than just having to accept that things are random and unexplainable and that you're just trading green bars and red bars, you know? So that's my whole spiel on penny stocks being crowded. And to top it off, I want to say that I think it's best to understand the momentum low float game as a game of skill and probability, no different than trading any other stock. If you do good, you make money. If you do it poorly with bad risk management and bad timing, you don't. And you forget what everybody else is doing. If you understand how to time these things with back testing, with experience, with, I don't know, intuition even, you'll make it work. That's what it is. Because stocks are always going to go up and down. Like, I don't know how it stops being an edge if you know what you're doing, unless there comes a day where these stocks go up and then they halt and then they go all the way back. Then they open all the way back down and never move again. Right? Until something that happens like that, they're still going to go up and down and back to where they came from. And your job is to try to understand the best possible spot in terms of risk reward and expectation to get in that, if that's what you want to add to your business, if you want to trade that at all. So that's my spiel on it. And I think all the conspiracy that people throw on Twitter is just noise. And I think people get lost when they read about it, thinking that they should focus on something other than the very fundamentals of how stocks move and how, you know, how the time momentum moves. That's what I think.
Yeah, that's awesome. So I really like the way you explain that too. It does seem like that narrative is really prevailing because it I guess it's one of those things where it seems like a no-brainer that this really crappy company that uses capital markets as a printing press. It seems too easy to short that, you know, with small size and just wait for it to come back down. So yeah, I do think it is a natural inclination, to try to explain it.
Category of doing something poorly. Like if you just short and you wait for it to go back down without an understanding of why it would go back down in terms of, you know, technicals or momentum, I think it's not a great way to trade these unless you have unlimited money, you know?
Right.
So that just goes to not doing it well. You know, if you don't do it well, that doesn't mean it's crowded and that it's an unwinnable game, because, like, you know, the
Right.
proof is that there other people are doing it and making money. So if those people exist, you can't just dismiss it.
Right. So you were talking before about a really crappy company with no financials going up for with bad financials going up for no reason. So
Yeah.
that really brings me to your CET situation, CETC situation. And do you want to give us a brief background of that before you go into maybe an update on it?
So yeah, 2 years ago, I traded a stock called CETC. I didn't know anything about it. It was just another ticker to me. Went up, massive percentage gain on no news. I thought there was a good spot to short it, so I shorted it. And then it went into a T12 halt, I believe, for the NASDAQ, or demanded more information on it. And most of the time when it happens, you know, stocks, it'll at least reopen. And, you know, you do have to, like, but in this case, the stock just, it never opened again. And so when they either open again on the NASDAQ, like even months later, or they get delisted to the pink sheets and OTC. And this stock never even got delisted to the OTC because apparently management disappeared and didn't file the proper paperwork to relist on another exchange. They're just like, hey, we're just going to give up on this company. We're just going to give up on our shares. And now I'm in this weird limbo zone where I cannot close out this short position because there's no market for it. And I have no idea when there will ever be a market. And the problem is that not only is the money, I'm not able to get the cash out of the position, but I'm also being charged interest rate on the position, you know, indefinitely. And it's hard to get answers. It really is. I mean, I talked to my broker and they're like, well, it's up to the clearing agent. The clearing agent has to eliminate the stock from their list of tradable stocks. And it's like, I'm asking, like, why don't they do that? The CEO gave up. All the management disappeared. Nobody says anything. Why don't they just give it up? And apparently he says, well, they have an obligation to the longs, whatever that means, to not do that. And, you know, I don't, you know, why doesn't the SEC or the NASDAQ get involved? Why doesn't the DTCC get involved, like do something? I don't know. It seems like everybody passes the buck on it. It's a very frustrating situation. The only good news I had on the stock is that 20% of my position was bought out, meaning there was a forced cover. And my broker tells me it was E-Trade. Apparently E-Trade made all their longs close out the position. So if their longs close out the position, the borrow disappears. So the borrow has to be forced back to recall. That means shorts get to cover, have to cover. And we covered at zero. I don't even know why that happened, but it's good that it did. And there hasn't been any good news since, unfortunately.
Oh, it's bad to hear.
Yeah.
Yeah. So do you think this situation, do you see it as like a bias against the act of short selling, that like they have the obligations to the longs, but they don't have an obligation to you?
I've heard conflicted reports of people like not being charged interest. They're stuck short, but they don't get charged the interest. And I don't know if there's some confusion in these conflicting reports where maybe that's not true, but I can't seem to like figure out why the juice is still running on me and not others. Like even that is hard to figure out. So even if this clearing agent has an obligation to the longs, I mean, at the very least, I shouldn't be charged interest.
Right.
Yeah, I mean, I'm not really sure why they feel they have an obligation to a company that very clearly wants to disappear. That's pretty stupid, if you ask me.
Gotcha. So another thing I wanted to update with you on is, you know, back during that big correction, what was it, around December 2018, was it?
Yeah, I remember that one.
Yeah, you talked about how that's a historic dip buying opportunity. Do you want to just give us an update on how that trade went? Because it seems like if you look at the chart, it would have worked pretty well for you.
I know, right? It's such a. It was a. I put a trade on it. I did get long, like almost near the bottom. I think 240 on the SPY, and I just treated it as a day trade, and I got out that same day, near the end of the day. It was a pretty good day trade, but nothing special. And I view it as a blown opportunity, considering all that I wrote. I think most of the traders I was speaking to wanted a kind of a gap down and like for the move to accelerate at the end. It just kind of stopped. And then it slowly crept up and it accelerated. And I don't know. I guess with a certain mindset that you're looking for this particular scenario for size, and if you don't get it, you'll compromise by lowering your size. That's what happened. It's a situation where I didn't think the conditions were A plus. Maybe they were like A minus or something. I mean, hey, maybe it is an A plus, and I just mislabeled it. But I didn't really size it or hold it as long as I should have. I didn't buy in any long-term accounts, unfortunately. I even flipped to a short bias, like 20, 25 points higher, and shorting the SPY on the way up. And I think I gave back the profit I did. And then I just said to myself, you know what? This was not good, and I'm going to wave the white flag. And then it went all the way back up to 300, and I'm just like in awe of this market. Really, this is like just watching the bull market of the last 10 years. Really, I'm just thinking to myself, I kept underestimating it, even if I didn't actively fight against it so many times. And it just seems so easy that blind trust would have given you the big bucks. So,
right.
Yeah, I'm not satisfied with that trade, but I was on the right track, I guess.
Well, thanks for the update. I just have two more brief questions for you, if you don't mind here.
Yeah, go ahead.
So, what do you think is like, as succinct as possible, like, what is the best like practice or study technique to improve as a trader?
Thinking about that one, because I don't know, it always feels like something with a long answer. I guess it goes back to what I was saying earlier about trying to define and categorize any situation you suspect has an edge, and trying to come up with an execution criteria that really captures that edge in a efficient way, and trying to apply it across all those specific scenarios.
Yeah, I think that's a really good answer.
And I think you want conditions that you can at least be able to explain to the layman why they work. For example, what did we just talk about? We talked about the SPY being down a massive percentage. And essentially at the core, it's like a mean reversion strategy. Like, we've been in a 10-year trend, and this is an outlier move. It's going to mean revert back to that invisible mean, wherever you define it. So with that in mind, how do you come up with a plan that really captures that move? That's where I feel like I kind of failed half of the equation. I had the entry equation, A plus perfect. It was the exit equation that was not A plus perfect, and maybe a problem in defining the scenario led me to have less size. So you want to define situations where you're like, okay, it went up because, that's just what happens in the market. Outlier moves in the S&P 500 tend to mean revert. That makes sense. That should make sense to people with rudimentary understanding of finance and anything like that. So you have those conditions. You try to come up with plans, mapping ways to really capture it, and you keep testing it around all those all those events where those conditions are met. If you can find them,
Gotcha.
that's what I think is a good day-to-day practice, practical to make you money.
Very nice. Very nice. And the next one, if you can remember back from like your prop trading days, what's like the strangest, most unexplainable, I guess outside of that AEPI trade, unexplainable way that you've seen someone make a lot of money?
There was an old guy at our firm, really nice, congenial dude. Offered me help when I left the firm in not so great circumstances. If I wanted it, and respected by most people. He had an institutional background. He always had these large positions in like companies like Qualcomm, General Motors, like very large positions, and there would just always be news in his favor. And nobody could understand why. And the only reason I know this is because he did not let people follow this account. But a good friend of mine saw it and told it to me. And yeah, I'm just going to leave it. I think I'm just going to leave it at that. I'm not going to say anything more because I don't know anymore, honestly. That's just, it was weird. Like, people didn't understand why he had these large positions, and then there would be news in his favor. Weird.
Yeah, that's probably more strange than that AEPI post market gap up trade.
Yeah.
So very, very cool. So yeah, to wrap up, man, I really appreciate you coming on. I love the insight you gave on some of these questions I asked you. I really appreciate it.
Yeah, thanks for having me. Enjoyed it.
For sure.
Hope it helped some people out there.
Yeah, I guess is there anything you'd like to leave the listeners with?
Guys, you read the paper. 97%. Don't fucking do it. Don't day trade for a living. That's my comment.
All right, that's
Good luck if you do.